Sarah had been saving for 7 years. Every tax refund, every bonus, every bit of extra income went straight into her investment fund. She'd watched real estate prices climb steadily since the pandemic, and mortgage rates that once sat comfortably at 3% had more than doubled. Her friends told her she'd missed the boat. Her parents wondered if she should just put the money in stocks instead, but here she was, standing in front of a modest duplex in a transitioning neighborhood, calculator in hand, heart racing, wondering if this was the smartest or the stupidest decision of her life. That single question kept her awake at night. Is real estate still a good investment in 2025? If you're asking yourself that same question right now, you're not alone. Millions of people around the world are staring at the same numbers Sarah was looking at, trying to make sense of a market that looks nothing like it did just a few years ago. The ground has shifted beneath our feet. Mortgage rates that seemed impossible in 2021 are now the norm. Home prices in some markets have pulled back while others keep climbing. Economic uncertainty looms large with inflation concerns, geopolitical tensions, and questions about where interest rates will land in the coming years. The real estate playbook that worked for decades suddenly feels like it's written in a foreign language. Yet here's what's fascinating about Sarah's story and why it matters to everyone considering real estate investment today. She didn't walk away from that duplex. She made an offer, and 6 months later she's collecting rent from both units, living in one side, and building equity faster than her savings account ever could have done. But her success didn't come from luck or perfect timing. It came from understanding something fundamental about real estate that transcends interest rates and market cycles. Real estate in 2025 isn't about catching the perfect wave anymore. It's about understanding the ocean itself. Let's start with a brutal truth that nobody wants to hear but everyone needs to understand. The real estate market of 2025 is fundamentally different from what we experienced during the pandemic years. Those days of bidding wars, waived inspections, and properties selling within hours of hitting the market have largely evaporated in most areas. Home prices nationally are down less than 1% year over year, marking the first negative price movement in over 2 years. In some markets, the correction is more pronounced, with Austin seeing drops of 10% and Denver down 5%. This doesn't mean the sky is falling, but it does mean we're in a recalibration phase where buyer and seller expectations are finally meeting somewhere in the middle after years of imbalance. The 30-year fixed-rate mortgage app with 6.22% as of December 11, 2025, and most financial forecasters expect rates to remain in this range throughout 2025 and into 2026. Compare that to the record lows we saw during the pandemic, when rates dipped below 3%, and you can see why some people feel like the party's over. But here's where perspective becomes crucial. These aren't historically high rates. In fact, if you look at mortgage rates over the past 50 years, the current rates are actually closer to the long-term average. The real anomaly was the period from 2020 to 2021 when rates hit unprecedented lows. We got accustomed to an aberration and now we're treating normal as if it's catastrophic. What does this mean for investors? It means the easy money has been made, but opportunities still exist for those willing to do the work and run the numbers carefully. Commercial real estate investment activity is expected to grow by 10% this year to $437 billion, showing that professional investors see value in the current market despite higher borrowing costs. The residential market is following a similar trajectory, with transaction volumes improving as buyers and sellers adjust to the new reality of what properties are actually worth in this interest rate environment. The mathematics of real estate investing have shifted, and understanding these new calculations is essential for anyone considering jumping into the market today. Let's break down what a good investment looks like in 2025 versus what it looked like 3 years ago. A common benchmark for a good rental property return on investment in the US for 2025 is typically between 8 and 12%. For leveraged properties where you're using financing rather than paying all cash, investors are generally looking for returns in the 7 to 10% range. These numbers are actually quite attractive when you consider that the stock market's historical average return is around 10% annually, and that comes with significantly more volatility and zero tangible asset backing your investment. But achieving these returns in 2025 requires more sophisticated analysis than it did when rates were rock bottom and properties appreciated automatically. You need to understand cash return, capitalization rates, debt service coverage ratios, and how to accurately project expenses that seem to climb every year. Property taxes aren't getting cheaper. Insurance costs have skyrocketed in many markets, particularly in areas prone to natural disasters. Maintenance and repairs cost more as labor and materials remain expensive. The days of buying any property in any neighborhood and watching it mint money are behind us. Today's successful real estate investor is someone who knows how to underwrite a deal properly and isn't afraid to walk away from properties that do indeed meet their investment criteria. Consider the 1% rule that many investors use as a quick screening tool. This rule suggests that a property's monthly rent should equal at least 1% of its purchase price for it to potentially generate positive cash flow. So if you're buying a property for $250,000, you'd want to collect at least $2,500 in monthly rent in 2025's market. Finding properties that meet this threshold has become more challenging in many areas, but they still exist. You just have to look harder, be willing to invest in emerging neighborhoods rather than established ones, or consider properties that need some work where you can force appreciation through strategic renovations. The rental market itself presents a compelling case for real estate investment right now. Here's why. Home ownership has become increasingly difficult for many Americans. At the beginning of 2025, around 31.5 million households could afford a median-priced home requiring a household income of $147,433. That is a staggering number that excludes the vast majority of American households from homeownership at current prices and rates. What happens to all these people who want housing but can't afford to buy? They rent, and they'll continue renting for the foreseeable future, creating sustained demand for rental properties. This dynamic creates what economists call a supply-demand imbalance that favors rental property owners. We're short millions of housing units in the United States. New construction hasn't kept pace with population growth and household formation for over a decade. While builders are trying to catch up, the pipeline of new units takes years to come online, and in many markets, land scarcity and regulatory hurdles make rapid construction increases nearly impossible. Meanwhile, over 30,000 new investors joined New Western Marketplace looking for properties to rehab in the first half of 2025 alone, showing that savvy investors recognize the opportunity that exists in providing housing to the rental market. Vacancy rates remain low in most markets, giving landlords pricing power they haven't had in years. When you have multiple qualified applicants for every available unit, you can be selective about tenants and maintain rental rates that support healthy cash flow. The multifamily sector specifically continues to show strength, with robust tenant demand driven by people who would buy homes if they could afford them but are instead renting out of necessity rather than choice. This creates a more stable tenant base with higher income levels than traditional renters, reducing vacancy risk and payment issues. One of the most overlooked advantages of real estate investing in 2025 is the tax benefits that can dramatically improve your actual returns. When you calculate that 8 to 12% return on investment we discussed earlier, you're looking at the cash flow before considering tax advantages. Real estate offers depreciation deductions that allow you to reduce your taxable income even while your property appreciates in value. You can deduct mortgage interest, property taxes, insurance, repairs, and operating expenses. If you're actively involved in managing your properties, you may be able to deduct up to $25,000 in rental real estate losses against your ordinary income. Depending on your income level, these tax benefits can turn a marginal deal into a great one when you factor in the real after-tax returns. Let's say you're earning a 9% cash-and-cash return on a rental property. After accounting for depreciation and other deductions, your taxable income from the property might be minimal or even show a loss on paper, while you're pocketing monthly cash flow. This tax-advantaged income is significantly more valuable than the same amount earned through wages or even stock dividends. When you eventually sell the property, you can use a 1031 exchange to defer capital gains taxes by rolling your proceeds into another investment property, allowing your wealth to compound without the drag of taxation. Let's talk about appreciation and equity building, because this is where real estate separates itself from almost every other investment vehicle. Even in a flat or slightly declining market like we're seeing in some areas right now, you're building equity through mortgage paydown every single month. Your tenants are essentially buying the property for you. Every rent check they write pays down your loan balance, increasing your ownership stake in an asset that history tells us will appreciate over the long term. Real estate has consistently outpaced inflation over extended periods. While we might see year-to-year fluctuations, the 20-year and 30-year track records show steady appreciation that builds generational wealth. JP Morgan Research expects house prices to rise by 3% overall in 2025. Suggesting that even in this recalibrated market, appreciation continues. 3% might not sound exciting compared to the double-digit annual gains we saw during the pandemic. But remember that you're earning that appreciation on the entire value of the property, not just your initial investment. If you put 20% down on a $300,000 property and it appreciates 3%, that's $9,000 in equity gain on a $60,000 investment, which represents a 15% return on your actual cash invested, not counting rental income or mortgage paid out. This is the power of leverage working in your favor. Location remains the most critical factor in real estate success. But what constitutes a good location is evolving in 2025. The traditional wisdom of buying in the most expensive neighborhood you can afford doesn't even necessarily apply anymore. Some of the best opportunities exist in secondary and tertiary markets that offer better fundamentals than the coastal cities that have dominated investment attention for years. Sunbelt markets still rule the rankings, particularly the larger super Sunbelt metro areas. But investors are also taking another look at snowbelt markets that were previously overlooked. Dallas, Miami, Houston, Tampa, and Nashville continue to attract both residents and investors due to job growth, lower taxes and quality of life factors that drive sustained housing demand. But here's what's interesting. Within these hot markets, the real opportunities often exist in neighborhoods that haven't fully gentrified yet. You're looking for areas with improving fundamentals like new businesses opening, infrastructure investments, rising employment, and demographic shifts that indicate growing demand. These emerging neighborhoods offer better cash flow because purchase prices haven't caught up to rental rates yet, and they provide greater upside potential for appreciation as the neighborhood continues to improve. The key is distinguishing between a neighborhood on the upswing and one that's simply declining. You need to study crime statistics, school quality, employment centers, and development pipelines to identify areas where positive momentum is building. Property type matters enormously in 2025, and different strategies suit different investors. Single-family homes offer the simplest entry point, with the most accessible financing and the broadest pool of potential tenants. They also tend to appreciate more consistently than other property types because they appeal to both investors and owner-occupants when you eventually sell. Small multifamily properties like duplexes, triplexes, and fourplexes offer better economies of scale while still allowing you to use residential financing, which typically offers better terms than commercial loans. You can live in one unit while renting the others, a strategy called house hacking that lets you dramatically reduce or eliminate your housing costs while building equity and gaining landlord experience. Larger apartment buildings and commercial properties offer higher potential returns but require more capital, more expertise, and more active management. The office sector specifically faces significant challenges in 2025, with remote work permanently reducing demand in many markets, but other commercial sectors like industrial, retail, and data centers show more promise. Retail enters 2025 with the lowest vacancy rate of any commercial real estate sector, and industrial properties continue benefiting from e-commerce growth and supply chain resilience planning by major corporations. For most individual investors, sticking with residential property makes the most sense unless you have specific expertise or partnerships that give you an edge in commercial real estate. Financing strategies have become more critical in 2025 because the cost of money significantly impacts your returns. At current interest rates, the traditional 20% down conventional mortgage might not be your best option. Consider alternative financing like seller financing, where the property owner acts as the bank, allowing you more flexibility on terms and potentially lower rates than traditional lenders offer. Private money from individuals in your network who have capital sitting in low-yield savings accounts might be willing to earn 6 or 7% returns by lending to you, which could be better than bank rates depending on your creditworthiness and the deal structure. House hacking, where you live in one unit of a multifamily property and rent the others, lets you use owner-occupant financing like FHA loans that require as little as 3.5% down. This dramatically reduces the capital needed to get started and allows you to learn the landlord business, while living on site to handle any issues immediately. Some investors are getting creative with partnerships, pooling resources with other investors to access better properties than any could afford individually. Real estate investment trusts and crowdfunding platforms offer even lower barriers to entry, though they don't provide the same level of control and tax benefits as direct property ownership. The risks of real estate investing in 2025 need to be addressed, honestly, because they're real and they can derail your financial plans if you're not prepared. Market volatility remains elevated with continued uncertainty about economic growth, inflation, and geopolitical tensions that could impact property values. Federal Reserve officials are ready to hit pause on rate cuts, meaning mortgage rates may not decline significantly in the near term and could even rise if inflation proves more persistent than expected. This could put downward pressure on property values in some markets as borrowing costs make homeownership even less affordable, potentially forcing sellers to reduce prices further to find buyers. Property management is harder than most new investors anticipate. Tenant issues, maintenance emergencies, vacancy periods, and the constant demands of being a landlord can quickly turn your passive income dream into an active stress generator. Even if you hire a property manager to handle day-to-day operations, management fees typically run 8 to 12% of gross rent, and you still need to make major decisions and handle situations when your manager can't resolve them. Some markets face additional challenges like rent control laws that limit your ability to raise rents, tenant-friendly eviction processes that can take months to remove non-paying tenants, and insurance costs that have doubled or tripled in areas prone to hurricanes, wildfires, or flooding. Liquidity is another consideration. Unlike stocks that you can sell with a few clicks and have cash in your account within days, real estate takes months to sell and involves significant transaction costs. If you need to access your capital quickly due to job loss, medical emergency, or other financial crises, real estate won't help you. This is why financial advisors emphasize maintaining adequate emergency reserves and not overinvesting in real estate to the point where all your capital is locked up in properties. You need liquidity cushion for both personal emergencies and property-related expenses, like major repairs or extended vacancies. So where does this leave us? Is real estate still a good investment in 2025? The answer is yes, but with important qualifications. Real estate is a good investment for people who understand the numbers, can access financing at reasonable rates, have the capital for down payments and reserves, and are willing to be active in managing their investments, either directly or through careful selection and oversight of property managers. It is a good investment for people with a long-term perspective, who won't panic if property values decline temporarily and who understand that wealth building in real estate is measured in decades, not months. Real estate is probably not the best investment for someone who needs liquidity, can't handle the stress of tenant issues and maintenance problems, doesn't have adequate emergency reserves, or is expecting to get rich quickly. It's also not ideal for someone who wants secure financing at competitive rates or who would be overleveraged and vulnerable to any income disruption. The key is honest self-assessment about your financial situation, risk tolerance, temperament, and willingness to educate yourself about how real estate investing actually works beyond the hype you see on social media. The most successful investors in 2025 are those who treat real estate like a business, not a get-rich-quick scheme. They run detailed financial analyses before buying, maintain adequate reserves for repairs and vacancies, screen tenants thoroughly, keep excellent records, understand tax strategies, and continually educate themselves about market conditions and best practices. They were patient in finding the right properties at the right prices rather than rushing into deals because they're afraid of missing out. They understand that every market is local, and what works in Phoenix might not work in Philadelphia. Looking ahead, several trends suggest real estate will remain a viable wealth-building vehicle for years to come. The fundamental shortage of housing units isn't going away quickly. Demographics favor continued housing demand, with millennials entering their prime home-buying years and Gen Z right behind them. Immigration continues to drive population growth in many markets. Remote work has redistributed demand geographically but hasn't reduced overall housing need. Inflation makes hard assets like real estate attractive as a store of value. The tax advantages of real estate ownership remain some of the best available to individual investors in the current tax code. Interest rates will fluctuate, property values will rise and fall, economic conditions will change, but people will always need places to live. That basic truth underpins the long-term stability of residential real estate investing. The strategies and markets may shift, but the fundamental opportunity to build wealth through property ownership endures. What changes is the level of sophistication and diligence required to succeed. The market rewards education, preparation, and disciplined execution more than it did during the easy money years. But the rewards are still there for those willing to do the work. Remember Sarah from the beginning of this video. 6 months into duplex ownership, she's learned more about plumbing, tenant screening, and cash flow management than she ever imagined she'd need to know. Some days are harder than she expected. But when she looks at her net worth compared to where it was a year ago, there's no comparison. She's building equity through rent payments and mortgage paydown. She's learning skills that will serve her for life. And she has positioned to buy another property in 2 years, using the equity she has built as a down payment. She didn't buy at the absolute bottom of the market, and she didn't get the lowest interest rate in history. But she is building wealth systematically through real estate. And the question is whether you are prepared to do what it takes to make it a good investment for you specifically, given your circumstances, goals, and resources. If you've been sitting on the sidelines waiting for perfect conditions, you need to understand that perfect conditions never arrive. What arrives are opportunities for prepared people who can recognize value and act on it despite uncertainty. The real estate market of 2025 offers opportunities that differ from what we saw in previous years, but opportunities nonetheless. Higher interest rates have created a natural screening process that's reduced competition and forced sellers to become more realistic about pricing. Properties are staying on the market longer, giving you time to do proper due diligence instead of making rushed decisions. Motivated sellers exist who are willing to negotiate on price, terms, or both, and the fundamental demand for housing combined with an adequate supply creates a long-term tailwind for property owners who can provide quality housing at fair prices. Your next step, if you're seriously considering real estate investment, is education and preparation. Study your local market extensively. Understand the neighborhoods, school districts, employment centers, and demographic trends. Network with other investors. Join local real estate investment associations. And learn from people who've been successfully investing through multiple market cycles. Get your financing in order by improving your credit score, building your down payment fund, and getting pre-approved so you know exactly what you can afford. Create your investment criteria so you're not tempted by properties that don't meet your minimum requirements for cash flow, appreciation potential, and overall returns. Start building your team before you need them. Identify good real estate agents who work with investors and understand investment property rather than just primary residencies. Connect with lenders who specialize in investment property financing and can explain all your options. Find contractors for repairs and renovations who are reliable and fairly priced. Research property management companies if you plan to use professional management. Line up an accountant who understands real estate taxation and can help you maximize deductions and structure your investments tax efficiently. Most importantly, take action. Not reckless action, but educated, calculated action. Analyze 100 properties to understand what good deals look like in your market. Make offers on properties that meet your criteria, even if you're nervous about being a first-time buyer. The worst that can happen is they say no, and you learn from the experience. The best that can happen is you start building the kind of wealth that comes from owning property that appreciates, generates income, and provides tax benefits all simultaneously. Real estate has created more millionaires than probably any other investment vehicle in history. And that track record didn't stop in 2024 just because interest rates increased. The investors who will thrive in 2025 and beyond are those who recognize that every market and environment offers opportunities if you know where to look and how to evaluate them. They're not paralyzed by fear of making mistakes. They're educated about risks and have strategies to mitigate them. They're patient in finding the right deals rather than forcing purchases out of desperation or FOMO. And they're committed to the long-term wealth-building potential of real estate rather than looking for overnight success. If that describes you, then real estate absolutely remains a good investment in 2025, not because it's easy or guaranteed, but because the fundamentals that have made real estate a wealth-building powerhouse for generations are still intact and still accessible to individual investors willing to put in the work. The market has changed, but opportunity hasn't disappeared. It's simply evolved, requiring more sophistication and diligence but offering rewards to those who adapt. Whether you're a first-time investor like Sarah or someone with experience looking to expand your portfolio, 2025 presents a different landscape than previous years, but one that still contains paths to financial success through real estate. The key is approaching it with realistic expectations, thorough preparation, and commitment to ongoing learning and adaptation as market conditions continue to evolve. Real estate investing isn't dead in 2025, it's just grown up. And it's now rewarding the adults who treat it like the serious business it is, rather than the lottery ticket some people hoped it would be.